Markets are forward-looking. That is rightfully so. When you invest, you put money away for a better and brighter future. However, is the future that the market is currently pricing the correct future? And if not, can we find opportunity in that? Well, the market is certainly pricing in a Goldilocks future and asking for a lot. Let's start with the interest rate market because that's where we have to start no matter the environment. This is an important area of the market. It determines the risk-free rate of return, and that prices the price of risk. Based on the Fed speak we've gotten just in the last week, it doesn't seem like the market is accurately pricing this. Bostic, while he did say he was leaning towards, another going higher versus lower if he had to choose between the two, he did end up walking those back, saying maybe he sees a pause at the next meeting. What matters here, though, particularly for the interest rate market, particularly for the 2-year Treasury yield, which is the most important yield kind of right now with regards to pricing in the Fed. He says he doesn't expect cuts into next year until well into next year. Let's do some math on this. You look at the 2-year Treasury yield, we'll call it 4% flat. The current Fed funds rate is above 5%. That means you can walk over, or somebody with a big enough cash pile, or a bank, and they do, can walk over to the Federal Reserve and risk-free get above 5%. But it's more than just risk-free. Unlike a Treasury bond, where you essentially lock up the money for the duration, you take on duration risk, you take on interest rate risk, you take on liquidity risk, you take on all these risks, you get a significantly lower rate. And that would make sense if the Fed was going to cut rates rather soon. That's what the market currently is pricing. That's what you see when you see a 2-year at 2%, but a Fed having interest rates and a federal funds rate above 5%. In order for this math to work, you either have to assume Bostic is incorrect and he's lying, which I don't. They have been on the hawkish end of the spectrum. The market has been calling for a pause for the last several Fed meetings. They haven't gotten it. In my opinion, we can't fight the Fed. That's a saying. I'm going to just take what the Fed is saying as the projection to follow. I don't think that's a ridiculous thing to do. I don't think we need to get fancy over here or complicate it, try to be a hero, try to fight the Fed and by a miracle being right. I don't think that's what we need to do. I think what we need to do is grant Bostic, the person with his hands on the levers of the decision, who says he expects inflation in the 3s by the end of the year, who says he won't cut rates if there's a recession, at his word, because it's very clear and easy to understand, straightforward. It makes a whole lot of sense when inflation's quite high, particularly core inflation, which we'll get to later in the video. So he's saying 5% well into next year, assuming no more rate hikes. We're not going to get to that discussion right now. Okay, well into next year. We'll for sake of estimates, we'll just assume that means this time next year. So that means for the first year of that 2-year bond, you're at 5%. So half of that return is at 5%. So for the second year, you need to be at 3% to make the equation work. But we're not going to go to 3% just like that at this time next year. We're going to slowly bring the rate down. At the last Fed meeting, which Goolsbee said today, they lowered the projections because it was so fresh off the banking stress. They're at 4.5% or thereabouts next year. That's a lot higher than 3%. The bond just simply doesn't make any sense. And then you add on that your money is tied up, that you're taking additional risks. It just doesn't make any sense. This is an example of the market pricing one thing and reality pricing another. This is just the interest rate market. Very important market. That's why we hit it first. But I'm trying to articulate to you what is my thinking to being not so optimistic in this environment and shouting, unfortunately, at this market for what in my opinion is like the most obvious mispricing of a very important asset and a lot of money that can potentially be lost as we may exit this trading range. It looks like in the stock market, a month-long trading range. But you look at the 10-year, the 2-year, it's also a trading range. We've had to go through a lot of worries, a lot of concerns, but at the end of the day, here we are on the other side of it. Nothing's changed. The Fed isn't cutting. They're not changing their forecast. Inflation, core inflation, more importantly, isn't down in a dramatic way. As a matter of fact, it's flat all year. You look at the month-on-month changes, flat all year. You look on the year-on-year numbers, 5.6, 5.5, 5.6, 5.5. Okay? Nothing has changed, but the stock market has gone very high, and bonds decided to start fighting the Fed. So that brings us to the next question. Where does the stock market go from here? Well, for the past month and for the past week, pretty much any time frame you want to look at, the market's been in the sideways range. It's possible it continues in the sideways range, but it's hard to do that. It's hard to do that because things are happening under the surface. Things are happening. I want to talk about some stuff that is possibly working on our favor. I want to selectively cherry pick some things because these are important things. Important things being Apple. Apple having peaked after hours, after earnings. Now we're pulling back. Not in a dramatic way, but the strength hasn't continued. It hasn't done what Microsoft did, which was continue to burst. It's done what Meta did. It's done what Amazon did. It's done what other companies have done. They beat expectations, saw a rally, and that was it because it was a single event. But now we're seeing the enthusiasm begin to dissipate as the upside catalysts have been realized. And the market dislocation exists in the risk-free rate of return. So today, we're seeing mega cap tech underperform. Some of them. Microsoft spent a lot of the day in the red. Apple basically spent the entire day in the red. It's one day. We can't look too much into it, but what was a late cycle bull rally, market getting very narrow, concentrating in the most confident names that are pricing in a Goldilocks situation, is now possibly showing some signs of cracks. Obviously, we can't say if that's going to continue, okay? In hindsight, we will know. But for now, we have to see what happens. One day, we'll see if it continues or if not. But ultimately, I want to get back to this Goldilocks notion. The market is forward pricing. And it seems to be forward pricing a lot of very good things. Almost the maximum possible good outlook. That the Fed begins cutting in just a few months, cuts several times by year end. Earnings begin to reaccelerate very quickly next year. However, when you look at history and you listen to the Fed, not in the rate projections, but in the rate effects, things don't make much sense. Why do I say that? I want to talk about the rate effects. We've all heard about these lag effects. This is what rate doves say to prevent the Fed from hiking further. Because let's not forget, core inflation has plateaued. It has not come down. It's plateaued. And it's not simply base effects or anything like that. You look at the month-on-month numbers. They're 0.4 basically all year, 1.5. That's not good enough. Okay? Just a few months of that, you're at 2%. But we have 12 months of that. That's 4.8%. Assuming no possible reacceleration, which if the economic strength continues, more so than we had expected, it might not. Anyways, back to the lagged effects. The market wants to price out whatever you want to call it, 6 months, 12 months. Well, we know it takes time for interest rate increases to trickle throughout the economy. We're just beginning to see slowdown effects on older rate hikes. And we've done some more recent rate hikes, and it's possible we might see another. I don't know, but it's possible. So this is not the bottom for the economy. It's going to continue to get worse. That's the expectation here. That's the baseline. That's the Fed's baseline. They expect unemployment to go up. They expect growth to slow. the economy is expected to continue to weaken. Recession or not, we don't know. Growth slowdown probably is going to happen when you have interest rates much higher than they were before. When you have banks constricting lending, being a little more cautious on deploying capital into the economy. So, the market is pricing in a Goldilocks environment for 6 months, 12 months in the future. They're expecting strong economy, strong earnings, reacceleration in those regards, falling inflation, and rate cuts. However, the reality looks very different, at least my interpretation of what the reality is going to be. And that is no rate cuts, high rates, roughly at this level this time next year, and an economy that is feeling the effects of higher interest rates, not completely shrugging those off into a re-expansion. So I think there's a very big disconnect between what the market is pricing in and what may actually end up occurring. And I think that is the play here, not buying the Goldilocks situation already being priced in. That's just what I think. It's been a tough year for me, but we'll see what happens. A couple months, no big deal at the end of the day. This is the way things are sometimes. You have to bet against the consensus and be right. Right now, the consensus is Goldilocks. We'll see who's right in the end. That's today's video, and until next time, peace out.